You're listening to the Scotiabank Market Points podcast. I'm your host, Greg White. Market Points is part of the Knowledge Capital series, a collection of audio, video, and written commentary from Scotiabank Global Banking and Markets leaders designed to provide you with timely insights and analysis. Last week, the International Monetary Fund downgraded its forecast for 2020 to a 4.9% retraction in global growth. Coronavirus cases are escalating in new areas, employment numbers continue to slide, yet retail sales are improving, and we've experienced significant gains in equity markets since the late March lows. So are things getting better or worse? Or is it too early to tell? On this episode of Market Points, Jean-François Perrault, Senior Vice President and Chief Economist at Scotiabank, provides his perspective on our economic prospects and some of the fundamental shifts we should prepare for. Hi, Jean-François. Thanks for being on the podcast today.
It's a pleasure to be here.
Lots of mixed signals between the economic data and the equity markets. They seem to be in a tug of war between pessimism and optimism over our current situation. How are you making sense of all this, starting with the rebound we've seen in equity markets? It seems counterintuitive.
Well, it does to some extent, but I think to get a good handle on that, you need to go a little bit further back in history and perhaps, closer to the peak of the crisis when we were seeing these very, very dramatic declines on a daily basis for equity markets. And the operating environment then was one in which we really didn't have a good sense of how things were going to work out from an economic perspective. We were, starting the shutdowns. There's still a lot of turmoil in funding markets. There was no sense that we knew whether or not the shutdowns were going to work. As a result of that, it was very difficult to assess whether or not there'd be a recovery sometime in the year. Fast forward a few weeks from then, and a few weeks going back now, and it became clear that the containment efforts that were being rolled out around the world were having their intended impact. And that is to say, they were slowing the progression of the virus, they were flattening the curve. And as a result of that, we started to have much greater confidence that there would be a rebound in economic activity in the later part of the year because the medicine that we've been taking to try and control the virus was working to some degree. So that's helps explain part of the rebound in equity markets. And of course, underlying all of this was tremendous amounts of liquidity that were being pumped in by central banks. Recently, the extent to which we've been able to maintain control of the virus is a little bit more questionable. We're seeing, obviously, in the southern U.S. and in the western U.S., a pretty significant increase in the number of cases. That goes beyond simply, those that are identified through more testing, and that, I think represents a pretty significant downside risk to the outlook. And I'm not sure markets have priced that in fully because markets are still reasonably buoyant, still, pretty optimistic about the outlook, and in some sense they're right to be that way. But there is, I think, mounting evidence that the downside risk associated with the virus in the second part of the year are, they're pretty clear, and perhaps we might have underestimated those a little bit.
So given those downside risks, how can businesses then best prepare in this environment?
I think the first thing to keep in mind is, nobody's really got a huge amount of confidence in their forecasts. I mean, the reality is that we are still dealing with a tremendously uncertain outlook. I mean, we can make a good argument for a second half rebound and that continuing in 2021, but the reality is that the virus itself remains reasonably poorly understood, and that represents a big risk to the outlook. So, you know, the point of departure is uncertainty is high and it's going to remain high for quite a while. So firms have to adapt to that, and firms are adapting to that. Um, but it means that, for instance, the return to normal kind of business conditions is probably going to be quite a lengthy thing. Maybe till late 2021 or early 2022, by the time we've got a sufficiently good handle on virus-related disruptions. By the time we kind of figured out, what other damage might have occurred in the economy as a result of this, whether firms are going to go bankrupt or not, or households are going to come back to the table. So it's just an environment where I think the focus is going to be on trying to set up businesses and business plans and strategies optimizing around a tremendously high level of uncertainty relative to what we might have been used to, just 3 months ago.
If 2022 is a realistic possibility for return to normal, have central banks run out of runway room with respect to monetary policy? Would we just be looking at fiscal stimulus programs to carry us through this?
Well, this is the kind of circumstance that is best designed for fiscal policy, anyways. So, I mean, I can get to the monetary policy issue in a second, but the reality is, the type of economic event that we're dealing with now basically requires financing to be provided directly to households and firms of some sort, whether it's a cash payment, whether it's a loan, and that, yeah, certainly in the Canadian context, is basically the job of the federal government or the provincial government. In the US, things are a little bit more mixed because there's this, the Federal Reserve has basically been doing fiscal policy as well in many ways. So there's this blending of what are traditional responsibilities or traditional kind of demarcations between the role of fiscal policy and monetary policy, which is kind of muddied the story a little bit in the US. But generally speaking, if we need further policy support down the line, if the virus comes back in the fall or something, I would imagine that the first line of response continues to be on the fiscal side because they effectively can, you know, put money in people's pocketbooks right away and either help them manage their finances or help them continue spending to some extent. On the monetary policy side, you're right that in a lot of countries, the rate is basically as low as it's going to be from a policy perspective. So central banks have been kind of undertaking these unconventional approaches to various things, quantitative easing in some countries. Governor Polas didn't want to quite call it quantitative easing in Canada, but effectively quantitative easing in Canada as well. And here the idea is simply that if we do find ourselves needing more interest rate support, so more easier financing conditions, it's pretty clear that central banks, certainly North America, aren't going to take their policy rates negative. I mean, the governors of both central banks have been as clear as they can possibly be on that, including the new governor, Tiff Macklem in Canada. What's much more likely, I think, if policy support is required, it will be, a ramping up of quantitative easing. So a ramping up of measures by central banks designed to bring down interest rates up the curve. They're already very low, but they're not at zero, so they could go lower. And that would be, I think, probably secondary to more fiscal. But that's the kind of intervention I would see coming out of central banks, certainly in the North American space. Just more attempts at yield curve control than we've seen so far.
On the consumer side of things, as we see people unemployed, not really being able to have disposable income to spend, and the government support essentially just providing basic basic requirements, money for basic requirements. Eventually, do you see a domino effect if this lasts too long, hitting businesses that up until now have been a little bit more resilient?
It's certainly possible. We've seen, without any question, a very significant increase in the unemployment rate in the unemployment rate in Canada. We've seen, roughly 8 million applicants for the Canada Emergency Response Benefit in Canada. So there clearly are lots of folks that have been affected by the virus from an employment perspective. There's no question about that. But the way the government support program has been designed for households has been really targeted. It's been pretty generous, and it's particularly generous for folks that are in the lower end of the income scale. So folks that are in the retail sector, folks that are in seasonal industries, food, accommodation, travel, and the income replacement rate for those folks is actually quite high. In fact, what we've seen partly as a result of this is the payments have been sufficiently high that deposits in banks have been rising. Obviously, it reflects some degree of consumption compression, but it does speak to the how extensive the government support is. Now, the question is, when is that government support going to be withdrawn, and is that going to leave households high and dry? And here, I think there's a view out there that the government is going to unwind things prematurely, and I don't subscribe to that view. I think if we find ourselves with still high unemployment rate in a couple of months, in a few months, I think you're going to see those employment benefits, emergency response benefits, remain active until we're well beyond this. And obviously that means it's expensive fiscally, but what I do think it means is that households are going to find that they are more supported by the government than perhaps they fear at this point in time will be the case. And that ultimately is great news from a household perspective. Now, obviously, we have seen declines in retail spending. There's no question about that. Part of that is because folks weren't allowed to leave their house for a while. Part of that is because you have lots of unemployment, lots of unemployed folks. Reduced confidence, folks just wanting to be more cautious with their finances in a period of extreme uncertainty. But we've nevertheless, since the peak of the crisis, seen a pretty dramatic improvement in retail spending. And that speaks partly to pent up demand. The household, there's only so long a household can go without purchasing a type of good that it views as essential. But it also speaks to I think what is still generally speaking the view of a lot of Canadians, probably most Canadians, that the COVID situation is a temporary situation and that they can kind of weather this. And one way to contextualize that is to look at the labor force survey in Canada. So the labor force survey does this interesting thing. For the last couple of months, it's asked Canadians, basically, how do they feel about their financial situation? Do they feel that they are under financial distress? And about a third of Canadians have said that they are, which is a pretty high number. The thing with that, though, is if we go back to 2016 and another survey the StatsCan publishes on a multi-year basis every 4 years, I think it is, which basically asks households the same question. Households were back then saying about the same thing. About a third of households were saying they were in financial difficulty. So households have remained reasonably optimistic about their financial situation, despite what is clearly an extremely difficult economic environment.
I imagine it's a extremely difficult environment for economists in general as well. Has this changed the way you forecast and how you look at economic problems?
It absolutely has. I mean, econometricians or economists that use kind of empirical ways of forecasting essentially rely on history to draw out inferences about the future, right? So historical relationships matter, historical correlations matter, and you use those to put a bit of context around your forecast. The reality that we're dealing with now is we are dealing essentially with a historical event, an event that is so large in terms of economic impact, an event that is so different in terms of policy response on the part of governments, that we have very little. Our historical toolkit is quite ill-equipped to help us make sense of incorporate this in kind of a forward-looking forecast. So we find ourselves, going back into our history books a little bit more, looking at for instance, the Great Depression or periods of extreme economic turmoil, like, pandemics, natural disasters in some countries, to try and get a sense of how those individuals reacted in those types of circumstances. But it does mean that we find ourselves using a lot more judgment, a lot more gut feelings than we are used to, just because the nature of the economic threat that we are dealing with is basically medical in nature. It's biological in nature. Even the medical community doesn't have a great sense of how this is going to evolve, and if you don't have a great sense of how that's going to evolve, it makes it very difficult to put an economic forecast around that. So that's extremely different from past kind of approaches of forecasting. Now we've adapted in a lot of ways. Obviously, we're looking at medical information much more so than we used to in the past. We are also looking at high frequency data much more so than we are doing in the past. So, for instance, Scotiabank, I mean, we are a very large Canadian financial institution. We have access to transactions data from our clients in all industries and all walks of life. And we can look to that data to give us a sense as to how we are evolving in real time, to give us more comfort that, for instance, the track that we think that we're on is in fact the right track. And so there's an adaptation that's occurring in terms of the types of data that we incorporate in formal views to try and triangulate as much as possible using as many different sources of information as we can to ensure that we're pretty confident that our view is on the right track, even though there's a huge amount of uncertainty around that.
When you have been looking at things lately, are you anticipating then a permanent shift in some structural elements of our economy, labor force, for instance, and how can we adapt to the coming changes?
Well, I mean, it's very clear that one of the challenges in dealing with a shock like this is there's a demand element to it. So, folks will want to purchase less things and firms will invest less because they're worried about the outlook. And there's a supply element to this as well. So, folks will be more hesitant to work, for instance. Firms will be more hesitant to deploy capital. They may retool their plants. They may retool their production processes to value safety over efficiency or over capacity. So, this is unquestionably leading to what we call in economic terms a supply shock. And part of this is clearly on the labor side. So you've got things, for instance, like in the short run, perhaps because of the generosity of the employment response benefit, there are individuals who are basically, making roughly the same amount with the benefit than they would when they were working. And for those individuals, or for a fraction of those individuals, the idea that they would go to work and basically make the same amount of money they're making by staying at home is not particularly appealing. So, you can count some of those workers out of the labor force for a time. You can also think about workers that have young children who can't find daycare. And those workers, one of the family members is going to have to remain home and watch the children for a period of time, and that precludes them from coming back into the labor market. And of course, you've got folks that are just worried about the public health dimension of this all, and will take more time off and be a little bit more cautious in terms of their kind of workplace interactions, and that too represents a bit of a labor supply shock. So as a result of that, you're likely to have less people wanting to engage in labor force until we have much greater clarity, about a cure or a vaccine for the virus than we certainly saw pre-crisis, and that is going to make it a little bit more difficult for firms to go back to normal levels of operating activity, because if you don't have the labor, obviously there's limits to what you can produce. And the same thing is obviously occurring in the business side. I mean, there are industries where we can anticipate that demand for their particular goods is going to be affected for the foreseeable future, right? You can think of travel, obviously. You can think of some types of retailers. You can think of restaurants. You can take, barbers and hairdressers and things that require a fair amount of social interaction. Those are, that segment of our economy is probably going to be smaller for the next year or two than we're used to experiencing. And there's a question as to how how those industries kind of move forward in a post-COVID world, and whether or not we as Canadians or we as global citizens will have altered our consumption pattern in such a way that even post-COVID these industries have a bit of a hard time.
When thinking about the bright side, uh, do you feel that technology played such a positive role in preventing what could have been a much more disastrous economic outcome?
Absolutely. I mean, there's been a lot said about AI and the rise of robots and how that's going to, displace workers and the challenges of managing workers in that kind of environment. I think what we've experienced with COVID in the last couple of months now is a very about as clear a demonstration of the benefits of this technology as you're ever going to get, in that the extent to which folks have been able to work from home, the extent to which we've been able to, shift our purchasing patterns using technology, the extent to which firms have been able to manage this through data analytics. It's all the function, obviously, all a result of how important technology has become in managing our lives and our economy. So, I mean, that's the starting point, which is, things would have been, I think, much, 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 much worse had we not been as technologically savvy and advanced and agile as we have. Now, of course, going forward, there still is going to be this concern that we're going to, technology will crowd out workers. It's been around for decades now, and it's going to continue to be the case for a while. I think one thing to keep in mind from that perspective is obviously, setting aside COVID for a little bit and the extraordinary nature of that development. If you go back to surveys of small businesses over the last 2 years in Canada pre-COVID, the number one constraint that these firms were noting was lack of available labor. I mean, we had been running extremely tight labor markets in Canada, and the US as well, but even tighter in Canada, such that the lack of available labor was actually an impediment to business growth. And as a result of that, you obviously businesses were adapting partly by adopting technology. So as we think about this going forward, if we come back to a period of time where the labor market returns to historical levels of tightness, which is what we experienced over the last couple of years, which I don't think is unreasonable to expect, say, over the next year or so. Like, again, the emphasis will be on firms using technology to meet their production needs, but it's going to occur in an environment where there already is a very, very tight labor market. Now, of course, one of the consequences of all this, and this is where there's an opportunity related to COVID, is as you continue on the technological transformation side, displaced workers need to be retrained, and clearly, because of the supply dimension to this, because of the labor stock dimension to this, there is going to be a need to retrain a tremendous amount of people that are in industries that are likely to be a bit smaller going forward. And that, again, will obviously, technology will help make that happen. But it's likely to lead to a situation where some of those workers shift to industries that are more likely to be sustainable going forward, or have kind of a more dynamic path going forward. And those are likely to be, again, industries that are technologically based.
That was Jean-François Perrault, Senior Vice President and Chief Economist at Scotiabank. You can find more thought-leading content from Scotiabank on our website at gbm.scotiabank.com, and you can also follow us on Twitter at ScotiabankGBM, as well as our LinkedIn showcase page under Scotiabank Global Banking and Markets. Please refer to our legal disclosures on our website. Thanks for listening.